Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Thanks so much for being on Swimming with Allocators.
Thanks for having me.
I think one thing I always like to do is start off with the person's journey. And so I was so fascinated with like all the things you've done in our pre-interview call. Could you just walk the audience through kind of your journey through private banking in New York and how you got into the world of family offices?
Yeah, happy to. So I started my career in New York doing wealth management, advising a lot of ultra high net worth families out of Latin America. So I spent 3 years at Credit Suisse, and then Morgan Stanley actually acquired the division that I was in, and so we all transitioned to Morgan Stanley. And that was just a great period, really transformative for my career. We are bringing on new clients, growing really quickly. And one of the main things I learned from that team, which was one of the best performing teams in Morgan Stanley, was just how relentlessly advocating they were for their clients, and just how they wouldn't take easy no's. When you're in a very bureaucratic environment like a Swiss bank or Morgan Stanley, you get bank pushing back on a lot of things, and they were just asking, why is this the case, and able to get like really good things for their clients. And so to start off my career, I mean, wealth management was fantastic, right? Because in terms of finance, you have access to most things. So we were doing equities, fixed income, real assets, and alternatives. So really good training ground. But if you go back to that period, 2012, 2016, it was kind of a golden age for venture, for alternatives. And so as more time passed, I became more and more drawn to alternatives. And I was lucky enough to have the opportunity to join a Latin American family office that is a very unique family office for Latin America because of its DNA. So it comes from a capital markets finance background as opposed to an operating company. And that just gave that family a very unique lens in terms of how they built out their family office, how they underwrote risk, and how they approached alternatives.
How did you balance both like learning and bringing putting your fingerprints on the strategy?
Yeah, I mean, it was a slow journey at first, right? At first, I just wanted to pick up as much as I could from what they were doing. But I think one of the main things from that family, going back to what I was mentioning, is how forward thinking they were. And since they were early in alternatives, they were always looking for kind of new initiatives, for giving me a lot of license to, essentially make mistakes, right? And learn from the mistakes. And so I'd say, we were there when we began navigating away from, so a lot of families started doing alternatives and doing like buyout on the private equity side, and then, some of the more established VC firms. But it was a family that began shifting away from that and moving on the private equity side to lower middle market, and on the venture side, building out an emerging manager program really early on. And I was kind of tasked with helping lead a lot of those efforts. And so it was a little bit of push and pull, right? That principle gave me that confidence, that security to do it. And then it was an area that I was, as I mentioned, really interested in. And so I was able to kind of just really focus on that.
You were one of the people I was always happy to share co-investment deals with around climate. And I'm curious if sort of that, what you've sort of taken from that lesson of being part of a trend, or having built a minor thesis focus area, if there's any lessons learned today of like how you think about what you're doing for families today differently.
In terms of like specific focus areas on co-investments?
Yeah, it seemed like climate was a big area of interest in that job. And has that taught you about how to sort of look at hype cycles, or,
Yeah, I think
if it changes how you do thesis-driven investing or focus area investing?
Yeah, I think when we think about venture capital, it's an already extremely cyclical asset class. And so just like there is parallel companies, there's parallel vintage years. And I think a big mistake that people make is getting too sector focused or theme driven for very specific areas. And so you're adding more cyclicality to your portfolio, more risk essentially. And so the way we try to approach it is we'd rather work with venture capital managers that have more of a first principles and like clear view of how they think the world is moving and where it's moving, and then try to back people in various different sectors. Because to your point about hype cycles, we've seen them come and go constantly in venture, right? And so you can go back and see just how many there have been. But if you focus too narrowly on one of these, you're essentially potentially putting money to work at really extreme valuations, high valuations, and the long-term results of that could be very questionable. So we'd rather be able to find a manager that has multiple deep themes that they're focused on, but they can move around based on where they're seeing the best talent, the best founders, and the best companies being formed.
There's a major self-awareness to not be doing those deals yourself. Where does a family office sort of get that self-awareness? Is it just a benefit of being outside the US ecosystem that you sort of know you need to access these deals through managers?
Well, I think the reality is, you learn by making mistakes, and a lot of families learn faster than others. But I think a lot of the journeys that family offices take is that they begin thinking they can do everything in-house. And so they think they can, why outsource venture in terms of managers when they can try to do it direct, because they see, I think they have this great deal flow. And I mean, I think if you really look at this space and spend time studying the space, it's an extremely difficult space to work at, right? I mean, venture managers who are fully dedicated to the space and have been doing it for sometimes decades produce subpar returns, and that's because it's really top decile funds that are really driving the returns for that asset class. So it's a little bit disingenuous to think that a family office can really outperform and do a better job than a full-time VC manager. And so, yeah, I mean, we would do some investments and we on the direct side where we were open to doing deals. But, we always had this lingering question in the back of our mind was, why are we getting access to this as opposed to a top VC firm out in the Bay Area or New York? And so if you try to do that, I think you're running the risk of creating adverse selection bias in your programs and investing in subpar companies and subpar founders.
I think that's such a good lesson, especially from a unique family office that had so much experience in alternatives to still have that self-awareness of like, hey, we should, partner with people and learn. And then we're able to kind of like, all right, this is what we're really good at. This is where we've gained a brand in. This is where we gained an advantage at. That speaks volumes. But we're talking to you today and you've created a new entity. Could you tell us about kind of like how you came to that journey?
Yeah, so I mean, when I was at the family office that I was mentioning earlier, I started developing a thesis around the space, which was there was other like-minded family offices that have very sophisticated pools of capital and internal teams, but that I wanted to increase kind of that bandwidth for alternatives because they really understood how complicated and hard it is to navigate. But by the same token, they were somewhat not attracted to or dissatisfied with the status quo of offerings. So if you think about the space, there's multifamily offices, consultants that feel too separated from what's actually happening at the family office level and understand the principles and stakeholders involved. And then also just fund the funds, and for various reasons, they'd rather be more involved in understanding what's going on. So we saw a white space for kind of call a different offering, which we call like extension of family office teams, which is being really plugged in with the families we work with, but just being dedicated to alternatives, and specifically within alternatives, focused on what we think is the higher potential pockets of alternatives, and that's private equity and venture capital. The private equity side is it's lower middle market, and on the venture side, mostly early stage venture, but investing across the board. And so with the with the original family that I worked for and their blessing, I was able to spin out and start Pomifer Capital, but they became our anchor client. And so in the process, was able to achieve complete continuity of focus and relationships and have that family onboarded with us. And that was really important.
You mentioned that like at Pomifer that the families, there's a certain type of family that you all work with. And so today you're looking to offer them, talk a little bit about the specific type of offerings. Is it one size fits all on your approach, or is it more kind of a customized approach when you're looking to help them when they're PE and VC allocations. Just talk to me a little bit about the strategies for all the families.
Yeah, I mean, it's a combination of the two, right? I mean, so to begin with, like the types of families that we're looking to work with are families that are either already very institutional or very clearly moving in that direction. And what I mean by that is families that have like a very clear asset allocation framework. They're trying to move away from, very centralized ad hoc decision making to having empowered teams, and want to have a dedicated and a real approach and program for alternatives. And so it's a family that wants to allocate to alternatives for many years. To begin a program, you should be thinking about allocating over 5 or 6 years, given some of the dynamics I already mentioned about that volatility, that power law vintage years. And so that we really want to understand too, like, what issues that family is facing internally, and really work with them to show them that we're not trying to replace their internal teams. On the contrary, we're trying to kind of continue empowering their team and be a really advocate for them in terms of building those alternative programs. And so it's a combination to your question, a little bit of the two, right? So like I mentioned, we are trying to find the higher performing pockets of venture and private equity. And so it's working with what we think are the best funds. So trying to find the very best fund managers, and then working alongside them to create co-investment opportunities. And so each family's specific allocation between private equity, venture capital, co-investments, and other adjacent strategies will be different based on where they are in their journey in building out their portfolios, their level of risk, if they want to do co-investments, if they want to do secondaries, and how truly patient they can be, right? Family offices, I think, are one of the best sources of capital when they're structured correctly, but they have two huge things to their advantage, and that's patient and flexible capital. And so if you can really structure those things well, that is how you can really compound capital and create even larger wealth, right? By holding on to winning positions and sometimes leaning into them.
Ooh, could you just tell us, maybe there's even an example of what that patient capital looks like how these things play out in reality?
Well, I mean, yeah, good examples, I have to be careful about sharing too specifics about some of the families, right? But at a high level, it's just families that are able to, since at a fund level, if you think about a venture firm, they do have to create distributions, DPI, right? DPI has become the new main metric that so many allocators track. And so venture firms have that pressure to, in close to that year 7, give or take, they need to find ways to create distributions. That can run counter to like how you compound capital, right? Because if you think about how some of these best companies continue gaining market share and really building even larger and more defensible moats, those are the type of companies you want to hold on to. And so, good examples of that are just, the families, the individuals that receive distributions on companies, call it like Tesla, or, on the illiquid side like SpaceX, and really held on to them. But there's many examples of that where in other programs, people would have a lot more pressure given the stakeholder dynamics to sell them early, given that maybe they're just taking bigger market share or larger percentage of that portfolio. But family offices can hold on because they can do real work, like first principles work around like, okay, maybe it is a large position, but how is it compounding? How is it growing? What are the dynamics around it? And so they can continue maintaining those positions.
So have you been on the coaching side of any managers saying, as one of your major LPs, we would much prefer you hold this position. We don't need the liquidity right now?
Well, what we try to tell them is, give that option to your LPs. Because we don't want to be we don't want to put ourselves in a position where we're trying to force a manager to go one way or another, because they have their own diverse set of LPs and the different needs that they might have, and we don't want to tell a firm to do something that's advantageous to us, but maybe disadvantageous to them as a firm long term, in terms of building and fundraising. So what we'd rather tell them is, if you have a great position. And you have pressure from LPs to sell, or maybe you're considering it, why don't you try to find ways of providing that optionality where the ones that want to sell can, where the ones who want to stay can stay. And so we've seen that with continuation vehicles are one of these words that, are all encompassing and can mean, lots of things. But I think a very well structured continuation vehicle can be very supportive for LPs and GPs.
Now we're going to take a quick break to speak with our sponsor.
These are interesting times on a macroeconomic scale. We are sort of seeing big swings in the public markets, and particularly around AI investments. People are saying, is this a bubble? With all this economic uncertainty, are you seeing that affect venture deals in any way?
Definitely. The immediate impact that I'm seeing right now is that things are moving slower in some respects, meaning new deals are taking a little longer from term sheet to closing for obvious reasons. I think people are taking their time to see what the markets are going to be, on any given day. At the same time, we're also seeing a big flight to what VCs view as the price possessions, right? So we're seeing this big focus on a few very highly valued companies. So there's a lot, despite what you read in the press. Yes, there's fundraising opportunities, but there's not as much of kind of a spray and pray type of approach right now, and there's a lot more of everybody going after the same hot companies. And so that also impacts terms. It also impacts how GPs are trying to get into that company because there's so much competition on the investor side. And I would say that as a result of that, what we're seeing is in some ways it's very much a buyer's, or I should say a fundraiser's market, if you are in the right place. And the last piece is what's impacting my work a lot is a huge level of consolidation, a lot of M&A, a lot of acqui-hires, a lot of talk of M&A and acqui-hires. And interestingly, and I don't think this has to do with the unsettling of markets, but rather maybe with the opening up of the IPO market a little bit, is we're seeing the return of the SPACs. A lot of SPAC conversations lately at earlier stage companies, which frankly I haven't had since 2021. So this is interesting and exciting. We're going to see where this goes into. You're seeing, this is just the beginning of it. We're seeing a lot of SPACs going public and raising money, but there's now conversations about de-SPAC transactions with AI companies, and there haven't been any high profile ones yet. So we'll see what happens in the near future.
Ooh, yes, that's fascinating. The SPACs are back. That's faster than I would have expected, actually. But it makes sense. It makes sense that with how much AI companies are able to raise, who are in that sweet spot, that they don't want to wait for that window to close. So one final question, specific to Sidley. You have spent your entire career, it sounds like, since law school in this sort of classic startup lawyer land, and you are a rather new addition to the Sidley team. I'm just curious what made you switch, what you're excited about at Sidley.
Yeah, well, so you're absolutely right. I spent my entire career in Silicon Valley doing this work, and give me a bit of a unique perspective on how it has evolved over the years. And it is a very different practice today than it was even 5 years ago, but certainly than it was 10 years ago. And that the kind of basic, rote knowledge of, in corporations and fundraisings and so on has been democratized, to a huge extent and automated. And so that is no longer really the competitive advantage, as much as I hate to say it, because I still do a lot of that work. And frankly, with AI, it's going to become less and less value adding because we can automate a lot of it. What we're seeing instead is our startup clients are growing and developing at this unprecedented rate. They're becoming global, frankly, on day one. They're raising money from all over the world. They have very sophisticated needs on day one. They want to license out their data. They have privacy concerns. They're going international. And so what they need is sophisticated, world-class global counsel. I'm still in Silicon Valley, but I do think that the practice today is so different than it was 10 years ago. And it was much more local, much more specialized in the specifics of fundraising and formation and so on. That is not anymore.
it sounds like the ratio of your time is spent less on the fundraising and sort of startup area, but more in the operations and some of those complex sort of business questions that really helps to be the ER doctor.
Correct.
Sending folks to the various specialists across Sidley. Interesting.
Yeah, and telling people from, my 15 plus years of experience doing this is where things can go wrong and this is where they cannot. And this is why you need to talk to, my analogy here, this is why you need to talk to the cardiologist tomorrow, aka the tax specialist, or not. And so that's the human touch of it. But what we've been able to do is also automate a lot of the, basic rote stuff that used to take a while, and that, to my point, used to be proprietary to a specific law firm. That is not anymore. What's proprietary is the kind of high level experience and expertise of kind of bet the company type of transactions that we can bring to the table.
And now back to our LP interview.
We spoke about earlier how you came into a unique situation, JD. And so you came to a family that knew a lot about alternatives. But for typical situations, people are a little naive when it comes to how easy or not easy it is to actually start a venture program. Could you talk to us about share kind of what you've seen on why starting a venture program there is a little bit of a struggle when going into it?
Yeah, I mean, I think families kind of underestimate a little bit how much venture has evolved over the last decade or so. So it's gotten extremely competitive. There's so many firms fundraising and so many different strategies and ways about building the program, right? And so you have emerging managers, established managers, you have pre-seed, seed, later stage, secondary strategies. And so it is quite confusing for families, but I mean, I think the main issue that family offices face, or just allocators face when building a program, is not probably diversifying their portfolio across strategy, manager, and vintage, as I mentioned earlier, right? But I think we've seen a lot of these issues. So like starting on that vintage year diversification, so a lot of people say, okay, I want to build out a program, but they end up doing that program over a very short period of time, so maybe 1 or 3 years in venture, and that's extremely dangerous, right? And it's likely that when they want to build those programs, they might be approaching it at a time when valuations and momentum and FOMO is high. And a good example is COVID ZERP era, right? Where 2020, 2021, people were heavily focused on venture and over deployed. And then 22, 23 came around and they didn't want any more because they felt they were at capacity. And that may be it's looking to be some great periods to have invested, right? So one is that vintage year. So really being slow, methodical to deploy, building your program over multiple years. So you're talking about 4, 6 years to really have good exposure. Then it's also having a good mix of strategies and managers. So on the strategy side, as I was mentioning, you want to have a good mix of strategies that can help you move forward in that J curve, that can provide distributions, and that can help you with that risk.
How do you filter for top, best, highest performing managers?
In terms of traits that we look for managers? Yeah, I mean, that's a great question. I think it starts off with the team. And so what we really look for is people that have a track record of excellence. And so that's either professionally, personally, or even aesthetically, right? So people who have high ability to sustain pain and have an ability to spot excellence in others. Like once you've achieved excellence, you can see it in others. And we think that successful people are never truly satisfied. They have a really high level of commitment. And then coupled with that is, there's so much around venture about, first principle thinking and really backing people that are differentiated. But there is very few venture firms are actually doing that because it's very uncomfortable, right? You have to have a view that other people don't. And a lot of these bets are going to go sideways or not return anything. But the ones that will are going to be extremely material for that fund. But it's trying to understand people's mentality, their thesis, and understanding if they are really, that first principles thinking. And then from there, it's just really trying to understand if they have a discernible edge in terms of how they source, select, and support their portfolio companies. And so on the sourcing side, it's understanding their networks and their nodes, not just the breadth of those, but also the depth. How much are they going to reach out to them? Do they have access to some of the best founders? Are people reaching out to them and trying to have them come in? And then their process, right? Is it there's always venture is a very qualitative process, but we want to make sure that there's some sustainability built in there, right? They didn't just very randomly walk in and meet someone. They are kind of creating this serendipity moments constantly in their lives. They're kind of putting themselves out there, have a strong brand, and so have a really strong top of a funnel that brings them some of these best founders. And then, sometimes do they have also value add that they can bring to their portfolio companies? And so if those things continue checking out, then what we want to make sure is that does the portfolio construction tie into that edge that they have?
JD, that was such a great response to the what you're looking for and the whys that you're looking for. But what are some great ways in how you found those answers?
Yeah, I mean, that's a really good question. Yeah, I mean, so I don't want to give up too much of my great questions for GPs, but I'll give this one away because I think it's really good. It's trying to understand like how willing are they to spot blind spots that they may have, and really pressure testing themselves. And so one of the questions that I really like to ask GPs is I ask them to call it the devil's advocate or that contrarian, and ask them if you're an allocator underwriting your fund, what are the reasons that you would come up with for not investing, and how they come up with those responses is really interesting, because we've had very institutional established firms really struggle with that. And to me, what that seems to indicate is that they're not thinking about like risks that they may have from other firms. They think they're maybe have too many answers. And some emerging managers are constantly maybe thinking about it a lot more. But it gives you a lot of clarity into their thinking and where they are. And so it's questions like that, like really trying to peer into them, that's very helpful for us in trying to understand those managers.
Speaking our language for sure. I feel like the theme of this show is like, what would your customer, how does the allocator feel about this response? You are sort of unique compared to many of our guests we've had on the show, that you're meeting as many PE managers as VC managers. Can you just help break down for us some of the big differences you see between how they're operating and just your insights right now looking at the two asset classes?
Yeah, I mean, from an allocator point of view, I think there's two that are very interesting. And so one is on the private equity side. What makes a successful GP and the background that they come from is very standardized. And so when you see a private equity manager, they tend to come from a very strong undergraduate program, have done work around investment banking, consultant, usually have done an MBA, and then went on to go to a great private equity firm or an important private equity firm, and then spun out. And so for that pattern recognition, know what funds to lean into, I mean, it makes the job quite a lot easier. But then when you think about venture firms, GPs can really come from any background. And then when I say any background, it really can be, right? You're thinking like, the most common are like ex-founders and operators, engineers, product leaders. But then you start going down that list, and it can be like ecosystem builders, people who have been in government, creative backgrounds, and they all have great ingredients to make great firms. And that's a beauty of venture, but it also makes underwriting extremely difficult, right? Because then you have to be very open to taking calls, to spending time with people, because they may have, like I mentioned earlier, a very distinct view of the world and where things are heading, and that can give them a really unique edge. So that's one, and I think that's a very good strength of venture. And the other one is just when you think about like data and transparency and where private equity has shifted, there's been a very conscious effort around private equity to provide very clear information for the most part of where portfolios stand. So it's not just the marks, but it's everything behind those marks, right? So where those companies are on a revenue point of view, how they've grown year over year. You can get very granular information on margins, EBITDA margins, projections for the next year. And on the venture side, that still isn't the case, right? For the most part, you can get data rooms that have SOIs and you have just high level marks, but a big issue with marks is that they can be either leading or lagging indicators, and it tends to be lagging indicators, unfortunately, on when things are going south, right? And so you can have companies that were marked really aggressively 2-3 years ago, and those companies haven't met those projections and what people hope for them. And so you can look at a portfolio, an SOI, and say, wow, this fund is marked really well. It's top quartile, top decile. But you really need to start peering under the hood and finding creative ways of gathering that information.
Yeah, I think that's a great segue in speaking about like your experience with co-investing in venture. And what I think actually kind of level setting to the audience, what do you think is most misunderstood about venture co-investing? Because I think people just kind of rope it into like, oh, it's all private equity co-investing, lower middle market, early tech. Oh, it should be kind of the same. But that it could be further from the truth, right?
Yeah, that's a great one. I mean, so when you think about private equity co-investing, the word means very much like what it should, right? You are investing alongside that manager, pari passu in the same round and the same terms, and usually it's no fee, no carry. And so it's a controlled process. You have full access to the diligence materials that they created, so their IM, quality of earnings. You can speak to the managers. You can really understand what's going on. And so there's no questions around, what are they really showing me here? It's a company that they're willing to put a sizable amount of their fund into, and so it's, I don't want to say easier, but it's it's a process that is a lot more structured and makes a lot of sense for allocators to, if you're already working with great managers, to put some more capital to work and build a satellite portfolio around co-investments. In venture, co-investments, the word is used often, but it really doesn't mean anything, right? It can mean anything for a lot of people. So you have on one end people selling their pro rata on rounds and charging full fees, and then you have firms that are investing and are giving you preferential terms as being an LP. And so that spectrum of what it can be is extremely, extremely large. But I think one of the big issues that allocators, LPs have when they venture co-invest is that they kind of expect what happens in private equity to happen in venture capital. And so they tell their venture managers, hey, I really like your fund, we're investing, and we also want to co-invest. But what they're essentially doing is they're putting the responsibility, the pressure on that VC manager to create these co-invest opportunities. But structurally, the dynamics around VC are very different. And so what ends up happening, or what usually happens, is that these venture firms have to find actionable co-invest opportunities for their LPs, but not necessarily the best ones, because they need to find something that has like a good lead, but is a slower moving process, and one where they can provide them some access to information and investment memos. But some of the best companies in venture rounds are either preempted or happen extremely, extremely quickly. I mean, we're talking 3 to 5 days or so, sometimes even less.
And how are you keeping track of, at the portfolio level? At this point, do you you're limiting however many managers you're looking to work with so that you can have deep enough relationships with all their portfolio winners?
So we're not trying to limit the portfolio that we have. We're trying to have a good diversified portfolio, as I mentioned earlier. But I think we make a list of the firms where we think we can have the best opportunity to find the best co-investments, because it's not about, you can't stay super close to all of them and run the strategy, the playbook that I just mentioned, but you can have a list of 5 to 7 people per person at the team that you can stay really close to at the GP level, and so that way you can run that playbook.
Yeah, it strikes me that by the time you're at the AGM and they're trotting those 3 or 4 founders out in front of all the LPs, it's a little competitive. As we sort of wrap up, JDB, you're in a very unique place where you are actively deploying capital. So who should be actually reaching out, and who can kind of qualify themselves as not a good fit?
I mean, we're very open. Like I said earlier, given our views on venture, we want to be speaking to lots of people and really understanding the ecosystem. But if it's someone who's building something unique and has a different view of the world, we definitely want to speak with them. And we try to be very accessible. I mean, we will reply to cold inbounds if they're done correctly, right? And it's very easy for venture managers to also find a way of getting a warm referral into us. And if it's coming from a trusted source, we for sure will try to take those conversations as well.
One last question. Is there anything in the market that you want to see more of, whether it's a strategy or, is there a certain strategy or team or, if you don't have.
I mean, I think it's just continuing to be really creative about how you build portfolios and what it means to build like a firm. I think, that this can be dangerous territory for some GPs, but like the 2 and 20 structure was built many years ago now, and it made sense in a different world. But are there models where that can be adapted? And we have seen managers shift away from some of those elements and create different structures that can hopefully create even higher alignment between themselves and the GPs, so that you have people feeling that they're on the same boat, right? That it's a win-win situation, and not have potentially managers that are just getting wealth off of management fees and not really optimizing for the carry, which is what obviously the LPs are. And so just people who are innovating around those areas is something that's very interesting to us.
What's a structure that sounds attractive, hypothetically?
Yeah, I mean, so a strategy that sounds attractive is so there's a couple of firms that come to mind that did 1% management fee and then traditional carry, because they've run the numbers themselves and they say, okay, if that, because if you're running 1% instead of 2, that's 10% management fee over the life of the fund instead of 20. But if that additional 10% is invested correctly in great companies, the whole pie will be bigger for the GP, but also for the LP. But that requires a GP that really believes in themselves, right, in their selection capabilities, and their ability to raise subsequent funds, because they have obviously a lower management fee. But that's something, it's really attractive for us because, like, as I mentioned earlier, it creates that even higher alignment.
It's like a commitment to recycling, in a way.
Yeah.
That you're going to be deploying more of the capital rather than using it to run your office.
Exactly.
Interesting.
Cool.
JD,
Well, JD,
congrats on your business. It's cool to see what you're doing for all these families.
Well, likewise, and thank you. You guys have built an amazing podcast here. I'm an avid listener and glad to be part of a small part of it as well.
thanks for being on, and everybody hit up JDB with a correct cold outreach.
Sounds good.
See you later, allocator.
After Portfolio Tile, investing with a smile.